Welcome to DF Markets Moving Averages. Moving averages are a brilliant example of what a great technical indicator should be. Simple yet effective. Moving averages basically tell us what the average price is over a specified look-back period. The moving part refers to the automatic function that means the average updates for each new session that develops, taking the new session into consideration and discounting the oldest session from the calculation. In their most basic form, moving averages are used as a directional guide for the market. When price is above its moving average, the market is classed as bullish, and when price is below the moving average, the market is classed as bearish. In this chart, you can see an example of how moving averages work. The blue line is the moving average, and while price is above the moving average, the market is classed as bullish. And while price is below the moving average, the market is classed as bearish. One very common way that traders use the moving average is to make trading decisions is buying price when it crosses above its moving average and selling price when it closes below its moving average. Another way to use moving averages is to use moving average crossovers. When using them in this manner, essentially what you're looking to do is apply a shorter term moving average and a longer term moving average to the chart. When the shorter term moving average is above the longer term moving average, the market is classed as bullish. Similarly, when the shorter term moving average is below the longer term moving average, the market is classed as bearish. In this chart, you can see an example of a short term and long term moving average in action. When the 50-day moving average crosses above the 200-day moving average, this means that the market is bullish. And when the 50-day moving average crosses below the 200-day moving average, this means that the market is bearish. Traders can use two moving averages like this as a directional guide. However, traders can also use them crossovers as directional signals to enter the market. When the shorter term moving average crosses the longer term moving average, traders can enter a short position. And when the shorter term moving average crosses above the longer term moving average, traders can enter a long position.